It is said that the American economy is still holding firm. The labor market hasn't collapsed. Consumption hasn't frozen. And America, as it has many times before, will eventually adjust. But if that's true, then why has interest payments on the federal debt become one of the largest expenditures in the national budget, exceeding many core social programs? This isn't on the stock market chart. Nor is it in short-term growth reports. It's in America's fiscal structure, where public debt has exceeded the size of the entire economy, and continues to swell silently. For decades, the U.S. federal debt was considered absolutely safe. Treasury bonds were considered a risk-free asset. The U.S. dollar was the ultimate safe haven whenever the world was unstable. But what happens when America itself becomes the largest debtor in modern history, and the cost of maintaining that debt is rising faster than economic growth? This crisis didn't come with a sudden collapse like in 2008. It didn't require people lining up to withdraw their money. It didn't require markets to close. Instead, it unfolded in a slower, colder, and more dangerous way. The total U.S. federal debt has surpassed 100% of GDP, a threshold previously only seen during wartime or exceptional crises. High interest rates are driving up the cost of interest payments, eroding budget space each year. And to maintain the current system, the government is forced to borrow new money to pay off old debt, a fiscal spiral that is increasingly difficult to reverse. These numbers, taken individually, may not create panic. But when put together, they tell a less pleasant story. Because this isn't just Washington's story. It will determine future taxes, how public services will be cut, what interest rates will remain, and ultimately, the economic well-being of tens of millions of American households. So, when will the U.S. default? How much longer can this fiscal system withstand the social cost before it becomes too great to ignore? To understand that, we first need to look at how the U.S. economy is being told on the surface, where the numbers still appear stable, while the risks are growing. On the surface, the story of the U.S. economy is still being told in a familiar pattern. Growth hasn't collapsed. Unemployment remains at historically low levels. Household consumption, the largest pillar of GDP, hasn't stopped. The stock market continues to reach new highs. From a distance, this doesn't look like an economy on the brink of crisis. Official reports show that U.S. GDP is still growing positively quarter after quarter. Employment figures are released regularly, with enough new jobs to reinforce the belief that the economic engine is still running. From this perspective, the U.S. is portrayed as an economy slowing down but under control, not falling into a technical recession. In financial news, the story usually stops there. Partly because these figures are real. Partly because they are based on standardized measurement methods used for decades. And partly because the market needs stable signals to continue functioning. Statistical agencies like the Bureau of Economic Analysis continue to release growth data in a familiar structure. Policymakers reassure that the economy is on a soft landing. And the Federal Reserve emphasizes its reliance on data, implying that all decisions are based on objective indicators. These figures are compelling. Because they are logical. Because they are consistent. And because they have been right in the past. But the issue isn't whether these numbers are wrong. The issue is what they measure and what they don't measure. GDP reflects the total value of production, but doesn't tell you who is bearing the costs. The unemployment rate reflects the number of people employed, but doesn't show the quality of work, real income, or spending pressure. The stock market reflects capital expectations, not household affordability. Meanwhile, the fiscal narrative, the foundation of the entire system, rarely comes to the center. Federal debt rises steadily each year, but is often presented as an abstract figure, detached from reality. Interest payments are bundled into the budget, rarely placed alongside spending on healthcare, education, or social security for direct comparison. When interest rates are low, this doesn't create immediate stress. But in an environment of persistently high interest rates, debt is no longer a static figure, it becomes a dynamic pressure, eroding policy space little by little. Yet, on the surface, the picture still appears stable. Financial markets react positively to any signals that things are not worse than expected. Indicators are cited constantly, giving the impression that the risks have been fully reflected. This is the key point. When an economy is judged primarily by short-term indicators and market reactions, structural imbalances are often pushed to the sidelines. Public debt, when it doesn't immediately cause a crisis, is easily seen as a problem of the future. But financial history shows the most serious crises rarely begin where the market is looking. They begin with slowly accumulating pressures where the numbers remain good, but society's resilience has begun to wane. And that's when you need to move beyond the surface picture and look down to the household level and real budgets, where the story of public debt is no longer abstract, but is increasingly present in every spending decision, every loan, every delay by the people. When you move beyond the statistics and down to the household level, the story of the American economy begins to change. Here, growth is not perceived through GDP. Stability isn't measured by unemployment rates. And economic health isn't reflected in green graphs. It's reflected in monthly bills, in steadily rising interest payments, and in the delayed decisions millions of families are forced to make. Nominal incomes for American workers may be rising, but real incomes after adjusting for inflation are not keeping pace with the escalating cost of living. Housing, healthcare, insurance, education, and interest payments are all piling up, causing people's economic sense to become increasingly detached from official announcements. In a persistently high interest rate environment, debt is no longer a neutral tool. It becomes a burden-shifting mechanism. Credit card debt with double-digit interest rates is used to cover everyday living expenses. Mortgage loans are becoming more expensive, not only for new buyers but also for households needing refinancing. Student loans, car loans, and consumer loans are all being impacted by rising capital costs. These loans didn't appear spontaneously. They are a survival response. When essential expenses rise faster than income, many households have no choice but to stretch their balance sheets. Savings are drawn in. Short-term debt is used. And defensive financial decisions become mass behavior. At the statistical level, these indicators are often reported individually. At the living level, they coalesce into a common feeling: prolonged uncertainty. It's noteworthy that this uncertainty isn't evenly distributed. The middle class, once considered the buffer zone of the American economy, is under the greatest pressure. Not rich enough to absorb rising costs. Not poor enough to be protected by assistance programs. They bear the burden of taxes, interest rates, and increasingly expensive public services. Here, public debt is no longer an abstract concept. As the federal budget allocates more and more resources to interest payments, the space for public investment shrinks. This is indirectly reflected in rising tuition fees, higher healthcare costs, slow improvements to deteriorating infrastructure, and tighter standards for welfare programs. People don't see the words public debt on their bills, but they feel it through what is no longer being paid for. Labor statistics from the Bureau of Labor Statistics show that jobs still exist, but the structure of employment has changed. Many new positions are in low-income, part-time, or unstable service sectors. Income is enough to have a job, but not enough to create a sense of financial security. When millions of people simultaneously postpone buying a house, postpone having children, postpone major spending, it's no longer a personal choice. It's a signal of a system that is passing costs from the macro level down to the micro level. The paradox lies in this. The economy is still functioning. Consumption continues. But it is sustained by debt rather than by sustainable income growth. And it is here that the link between public debt and living standards becomes clearer. When the government borrows for extended periods to cover deficits, the private sector competes in the same interest rate environment. The cost of capital spreads. The pressure to pay interest doesn't stop at the federal budget, but flows through the financial system, to businesses, and ultimately to households. The discrepancy between figures and living standards isn't a measurement error. It's the result of a structure where debt is used to delay adjustments, rather than to address the root causes of imbalances. And when adjustments are delayed long enough, the system begins to accumulate risk in a way that is difficult to reverse. If Americans weren't spending irresponsibly, if they weren't poorly managing their finances, then what mechanism has pushed millions of households into such a prolonged state of financial defense? The answer doesn't lie in individual choice. It lies in the operational structure of the entire system. To understand why U.S. public debt is no longer a distant future issue, we need to move beyond superficial phenomena and delve into the operational structure. It's not a single decision, but a series of mechanisms that have accumulated over decades, now simultaneously amplifying each other in a high-interest rate environment. The first link in the chain is the structural budget deficit. The United States has long been accustomed to spending more than it earns, even in the absence of crises or wars. Deficits are no longer a temporary tool to bridge through recessions, they have become the default. Even favorable economic cycles don't generate surpluses, and the room for adjustment erodes over time. In this context, debt increases not only because of large spending, but also because of a lack of reversibility. Each year, the fiscal system takes another step into inertia, borrowing to maintain current operations, rather than borrowing for investment to create the capacity to repay debt in the future. The second link in the chain is the reversed interest rate environment. For more than a decade, extremely low interest rates masked debt risks. Cheap borrowing made deficits bearable, and public debt was considered sustainable. But when interest rates returned to higher levels, that logic reversed. Debt no longer stood still, the cost of servicing debt is ballooning exponentially. This is the key point. The issue isn't just how much debt there is, but the rate at which interest payments increase relative to economic growth. When interest payments rise faster than GDP, debt becomes a drag, forcing the budget to allocate more and more resources just to maintain the status quo. The free budget for long-term investment therefore shrinks. The third link is the structure of spending that is difficult to cut. The majority of the federal budget is tied to mandatory programs, Social Security, healthcare, and subsidies. These are expenditures tied to demographics and long-term policy commitments, making them difficult to adjust quickly without causing social backlash. As the population ages, this pressure increases over time, regardless of the economic cycle. Meanwhile, discretionary spending cuts are often focused on infrastructure, education, and research expenditures with long-term effects on productivity. This creates a paradox. To maintain short-term stability, the system sacrifices a foundation for long-term growth. The fourth link is the market's dependence on U.S. public debt. U.S. Treasury bonds are not just tools for financing the budget, they are the foundation of the global financial system. Banks, investment funds, and financial institutions use them as collateral, as a measure of interest rates, as a safety benchmark. This creates sustainable demand but also creates a two-way dependence. As public debt swells, the global financial system becomes increasingly intertwined with U.S. fiscal capacity. Any fluctuation in confidence, however small, can have far greater ripple effects than initially anticipated. Therefore, risk is no longer an internal matter, it is systemic. The fifth link is policy lag. Fiscal and monetary decisions have long lags. When deficits widen, negative impacts don't appear immediately. When interest rates rise, the cost of interest on debt doesn't increase immediately because debt has a fixed term. This lag creates a false sense of security, delaying adjustments until policy space has narrowed. Here, the role of the Federal Reserve becomes sensitive. Monetary policy is designed to stabilize inflation and the economic cycle, not to finance the budget. But when high interest rates expose the cost of debt, political pressures and market expectations begin to overlap, blurring the lines of policy. The final link is the financialization of growth. For years, growth was sustained by expanding the balance sheets of the government, businesses, and households. This delayed adjustments, but at the same time increased leverage across the system. When the cost of capital rises, all links are under pressure, with no buffer to absorb the shock. When these links are placed side by side, the picture becomes clearer. U.S. public debt didn't rise because of a momentary mistake. It rose because of a structure that encourages deferral, where costs are pushed into the future, while benefits are consumed in the present. And when that future arrives, the system doesn't collapse in a single moment. It erodes piece by piece, through tightly controlled budgets, through increasingly limited policy choices, and through difficult decisions forced to be made under time pressure. When the fiscal system is under pressure, the impact doesn't stop in Washington. It spreads outward, through the private sector, and back into social life in less discussed ways. When the fiscal system is tightly controlled, the impact doesn't stop at the federal budget tables. It spreads in a chain reaction from government to financial markets, from markets to businesses, and from businesses back to local communities. In the first layer of diffusion, high and prolonged capital costs become a drag on the private sector. Small businesses, which rely heavily on short-term credit, are affected earliest. Their ability to borrow new funds decreases, refinancing costs increase, and expansion decisions are delayed. This doesn't create an immediate shock, but it creates a widespread economic inertia: less hiring, less investment, less risk taken. At the next level, local communities begin to feel the effects acutely. As federal funds are siphoned off to pay interest on debt, federal aid, grants, and investments struggle to keep pace with real needs. State and local governments are left to fend for themselves in a high interest rate environment, where local bonds become more expensive. The consequence is delayed infrastructure maintenance, underfunded schools, and streamlined public services. These impacts rarely appear in the big headlines. They are dispersed. They don't happen all at once, but they accumulate over time. One of the biggest risks often overlooked is the confidence effect. When businesses and households believe that the cost of capital will remain high and public spending will continue to be tight, economic behavior shifts defensively. Consumption becomes essential. Investment is shifting to short-term, and all long-term decisions are being postponed. This creates a negative feedback loop. Slower growth makes it difficult to reduce the debt-to-GDP ratio, further tightening fiscal space. Another less discussed risk is refinancing in an unfavorable environment. U.S. public debt has maturities, meaning interest costs don't rise immediately. But as old bonds mature and new ones must be issued at higher interest rates, the interest burden increases in stages. This process is insidious, but once it begins, it's difficult to reverse in the short term. At a deeper level, there are statistically invisible groups that are most heavily impacted. Long-term renters face rising living costs while their incomes don't keep pace. Freelancers and part-time workers lack access to cheap credit and are easily pushed out of the market when financial conditions tighten. The elderly living on fixed incomes face the double pressure of medical costs and interest rates. These groups don't cause market crises, but they create potential social crises. At the financial level, the banking system and credit channels also suffer ripple effects. Credit growth slows, lending standards are tightened, and risk absorption capacity decreases. This doesn't necessarily lead to collapse, but it reduces the system's overall resilience at the very moment it's needed most. One often overlooked aspect is the interaction between public debt and the economic cycle. When a recession, even a mild one, arrives, policy responses are constrained by high interest costs and fiscal pressures. The ability to stimulate the economy is limited, making small shocks more likely to last longer than usual. Here, the risk isn't in an extreme scenario. It lies in the gradual erosion of responsiveness. When budgets are locked, policy becomes reactive. When the response is slow, market expectations shift. And as expectations shift, economic behavior adjusts defensively, slowing growth, increasing debt pressure, and continuing the vicious cycle. The key takeaway is: this type of fiscal crisis doesn't need a clear trigger event. It develops in a gray area where things still work, but no longer work effectively. And it is in that gray area that confidence begins to erode. Not through panic, but through a lingering feeling that the system is serving to maintain the status quo, rather than to create a sustainable future. When confidence becomes a fragile variable, the story is no longer about how much debt there is, or what interest rates are at. It becomes a larger question of expectations and sentiment factors that can themselves create recession, even without a surface shock. In economics, confidence is not an abstract concept. It is a real variable, governing the behavior of millions of individuals simultaneously and therefore, has systemic weight. When people believe that future incomes will be stable, they consume and invest. When businesses believe the policy environment has room to react, they accept the risk. And when the market believes the government has fiscal space, shocks are absorbed instead of amplified. The problem in America today is not an immediate default. The problem is that confidence in the system's ability to self-correct is eroding. Not by a shocking announcement. Not by a symbolic event. But by the lingering feeling that all solutions are temporary, and all costs are pushed forward. As budgets become increasingly constrained by interest costs, policy becomes more cautious. When policy is cautious, the response slows. And when the response is slow, expectations of people and businesses change. They don't wait for crises, they adjust. The consequence is a defensive economy. Short-term consumption is prioritized. Long-term investment is delayed. Risk is avoided, even when innovation is necessary. These behaviors, considered individually, are reasonable. But when occurring simultaneously on a large scale, they create a pull against growth. Here, public debt acts as a psychological amplifier. It reminds us that each new shock, however small, will be handled within a narrower policy space than before. And that awareness is enough to change behavior, even before a crisis surfaces. It is noteworthy that the system can remain in a state of instability without collapsing. But the price is not measured by a single number. It is measured by missed opportunities, delayed decisions, and a society increasingly accustomed to accepting less. The story of U.S. public debt, therefore, is not a story of the distant future. It is a story unfolding year after year, budget after budget, decision after decision. Will America adjust while there is still time and room for maneuver, or will it only realize its limits after faith has been exhausted?